Let's start this problem off similarly in being very intentional about the ways that we are going to lay the spreadsheet out to categorize this. So we see immediately that we start with equity again, and the equity we see to begin with is a book value, and it's given to us as $10 million. It then tells us that we have a book value on a per share basis of $20. It then tells us that there is a ratio of market to book currently at 1.5 and that the returns that an investor expects associated with that stock is 0.15. Let's go ahead and then deal with the second set, which is bonds. So what do we know about bonds? Bonds then have a face value of $5 million. Well, a synonym for face is book. So I can align that in that same row in the spreadsheet. You also know, based off of our history, that if it's not shown to you, the traditional book value per bond or par value per bond was always 1,000. So we know that that can be correlated with this same row too. They sell at a price of 110%. Well, guess what? That's the same concept of market to book ratio. What's 110%? 1.1 times of what its face value would be. And then the returns associated with bonds is 9%. So in this particular case, with just understanding the synonyms that can be used between bonds and stocks, we have a nice dense table with common row headers. The only thing that is not necessary for both is the tax rate, which will then apply only to the bonds, and it will be 40%. For the weighted average cost of capital, the way I always think about the weighted average cost of capital is it's the rate times the weight plus the rate times the weight. And then add them up, where the weights are based on market values. We do not have specific market values to work from here, but we have the data that we need to calculate those. If we were to refer to the spreadsheet that I posted as a formula that you can take into the final exam, we see within this WACC calculation some specific terms like D and V and E. So I'm going to go ahead and use those terms in terms of this is going to be my market value, where in the formula sheet this is the term E, and in the spreadsheet this is the term D, D for debt market value, E for equity market value, and then this will be our total. And our total in the spreadsheet, the term is V in the spreadsheet. Well, in order to get market value is always just equal to number of securities, whether that's stocks, shares outstanding, or that's bonds issued and outstanding, times current market price. Shares times price. That's all market value is. But that means we need to have two separate inputs into each in order to be able to get market value. So let's parse those out. Number of securities and then current price. Like I showed on the board a bit earlier then, how do you know the number of securities you need? If I take the book value in total and I divide it by the book value per share, I get number of securities. In this case, 500,000 shares. If I do the same thing for my bonds, if I have $5 million in bonds, each of which had a book value of $1,000, then I should have 5,000 individual bonds. What is the price for each? We were given a ratio that said at a $20 book value per share, those shares are currently selling at 1.5 times in the market what they are shown in the book. So there is a $30 price associated with each. For bonds, we were told that as compared to their face value, they are selling for 110% of their current face. So bonds are selling at $1,100 each. So the market value of our equity then is shares times price. I just goofed up my formula twice, so we'll redo it. Securities times price. $15 million, which shouldn't surprise you. If the book value is $10 million and they're trading for 1.5 times, $15 million is the current market value. How about our bonds then? If we have each bond selling at 1,100, in total, the market value of my bonds is $5,500,000. And the market value of all of my securities then is going to be just over $20 million, which again looks favorable compared to book values because the market has changed. Both our bond prices and stock prices have increased, so the market values have gone up. We can use then those terms to define our capital allocations. In the formula that I showed in the spreadsheet that you can bring to the final, those are these terms over here, D over V and E over V, the percentage of your total securities allocated from stock, the percentage of your total securities allocated from debt. So the capital allocation tells us 15 million of our 20,500,000 is related to our equity value, and 5 million of our 20 million is allocated to our debt values. Not surprisingly then, if we add these up, they should be equal to 1, because this firm gets its money from either stock or bonds. Approximately 73% from stock, approximately 30% from bonds. Now that we've got all our pieces, we can do just the WACC formula all together, where we can, I don't think I documented the returns though, did I? No, oh yeah, I did, they're up there, good. So we've got everything we need for the formula. So if we use rate times weight, here is the rate that stockholders get, and here is the weighting, or the percentage allocation associated with stock, plus here's the rate for bonds multiplied by the weight for bonds, with the minor adjustment of having to take into account the tax rate. And there is now our WACC for this firm.